Hey guys, Boris Schlossberg. Welcome to Trader Fade for the week of March 13th, I guess, to March 18th on the next week. I think, first and foremost, we've got to start with a review of what we did last week, which was a very out of the box idea to short oil as it spiked higher into that whole double top zone around 120. And my recommendation was to essentially do a scale up short 120, 125, actually 115. Let me be clear. 115, 120, 125, 130 with a stop 135. And yes, it was a very vertical move, but actually the strategy worked out beautifully if you had done this because we did take it all the way back as oil essentially collapsed after just a complete short covering squeeze at the beginning of the week on utter panic. That having been said, though, I think the trade going forward becomes a lot more problematic. This was a pretty easy call if you know how parabolic markets can get and understand volatility. Now, the situation certainly seems to have kind of gone into a war of attrition, both in the economic market and unfortunately in the actual political market with Ukraine. But it's unclear, certainly unclear, as to whether this conflict is going to worsen or perhaps desist as the next week goes by. There are some inklings of a diplomatic solution, but it's very, very hard. At this point, everybody is just trying to read Vladimir Putin's mind, and I think it's impossible to read a mind of a maniac. So therefore, it's really, really hard to kind of have any confidence as to where the trades are, with one exception, I would say. I don't think, so this elevator down, escalator up, which is a typical move in any kind of parabolic markets. I don't think the uptrend is done. Yes, it's certainly been a parabolic uptrend, but I absolutely do think that if we have a correction below the 100, that's probably going to represent a very interesting buy. So in fact, you probably, I guess, if you want to follow the game plan that was very successful last week, and given the volatility in the market and given the level of uncertainty, we have to, I think, at this point, kind of shift our focus from shorting to getting long. So here, perhaps maybe the smart thing to do would be to be a scaled down buyer at around 104, 100, 95, and then a very hard stop, probably below like 92. Now, there is a danger with this strategy, and I fully want to warn you about it. Is that, let's say if peace does break out, there'll be such a massive short covering liquidation that it's very likely that we could trigger the stops all the way down to 92 before it bounces back up. So kind of scale down buying could still take you out of the trade, and then the trade could rally forward. But that's the risks we have to take. It's impossible, I think, to try to guess the bottom. You have to cushion yourself into it. The more important point, I think, is that because so much oil has been taken off the market, because the economy globally still remains very, very strong, it's difficult to imagine a situation where we have a pure upside down V decline. That, as fast as it goes up, it's going to go down. I think we could bounce around, we consolidate a little bit further up. It's very likely the highs have been made unless the hostilities sort of go to a horrible place where I think nobody even wants to talk about in Ukraine. Then all bets are off, and you could have a spike. Ultimately, I really call long oil and long gold, what I call the pro-Putin trade, and the John Lennon trade is long Nasdaq and kind of long Bitcoin, sort of pro-risk trade. Gold was a similar type of situation as oil in a sense that this was a parabolic move on massive risk aversion, and it came back down. And that strategy worked out quite well as well, which is that you sold 1950s, 2000s, 2050s. 2200 was my recommendation, and I still remains. To me, I still don't think gold is likely to break the 2200 level at this point. That having been said, though, we are at mid-month support here on gold, and it's quite likely that we could just be bouncing around here for a small pop. I don't have any hard conviction here both technically or fundamentally as to where I think gold can go, and it's probably best just to stand down at this point, unless you sort of want to scalp your way around the 2,000 mark. Um, it's difficult to gold has clearly attracted a lot of risk off flows, but it's still very much a sentiment driven trade. And yes, if you just, as I said, if you really think that it gets much worse, if you really want to, in many ways, I think the pro-Putin trade, in a sense of like horrible war and further humanitarian damage, is probably going to be expressed strongest in gold, as everybody's going to run to this asset. So if you really feel that the darkest days in front of us, it's not an unreasonable, assumption given the terrible geopolitical situation that's going on. That's probably still a very decent bet. But I don't have a strong opinion either way. Technically, it's midpoint. It's probably just best to stand down unless you genuinely think things get much worse from here. Now, the next asset on the plate is, I think, the most interesting because, I put this in a basket. I call this the pro-John Lennon trade, the pro-peace trade, in a sense that when risk was positive, it kind of rallied with it. But we've had an interesting fundamental piece of news that infused itself into the crypto markets that is clearly having a very, very serious supply overhang issue, which is that there was quite a lot of reporting last week or this week that the Russians were actually liquidating their Bitcoin holdings because that's literally the only thing that kind of wasn't frozen, right? It's the only assets they had where they could raise cash quickly. And it makes sense if you're looking at the charts that there was this massive, massive reversal. Although, in all fairness, add that to the idea of risk off flows, which we had at the end of the week. It's not inconceivable to think that people are just jumping on the bandwagon. That having been said, at this point, I think the charts are pretty clear. The support is this basically this 36,000 level, right? That's the monthly support level. If that holds and consolidates, there's a chance that we re-rally. That having been said, crypto to me is now range bound big time. We've had this massive, massive bear market in crypto, and now we're just having the bear market range, and it may very well be dead money for quite a long time. I think it's quite ironic that everybody thinks that Bitcoin is sort of like the most interesting asset, when I think it probably will be the single most boring asset going forward. And volatility, you're starting to see, is going to compress and compress and compress. And perhaps only when nobody cares about crypto, at that point, it's going to begin to be an interesting trade. In the meantime, if you want to play the range bottom, certainly you want to be a buyer somewhere around here with a hard stop below 3,600. If you assume that the Russians have sold everything they wanted to sell, it's probably a decent place to make your stand. But again, it's not an asset that really has a clear, definitive, fundamental theme at this point. So you're just trading the technicals and giving yourself your best shot. Now, equities, on the other hand, looking pretty ugly. And of course, the poster child for risk is NASDAQ, because that contains the most risky flows. And I think what you're having here, and especially as I'm looking at the today's candle, the Friday's candle is really ugly. We run to the monthly midpoint, create highs, and then just literally close on the lows. That's just classic technical analysis, bear market. Having said this though, it means absolutely nothing if we wake up Monday morning and there's some kind of a peace treaty between Ukraine and Russia. So you have to take all of the charts with a massive understanding that the fundamental is going to completely drive the story. But if you sort of assume, which is what the charts are telling you, is what the market is telling you right now, is that the war remains a grim reality, that we're essentially now in a war of attrition. There could be, unfortunately, kind of a slow strangulation of the Kiev region by the Russian forces, and lots of kind of hand-to-hand combat that we haven't seen since Stalingrad in 1943. And all of that obviously creates just a horrible situation globally as far as risk. And weighs down an asset. Adding to that, the fact that central banks, even if they're going to be modest, and we'll talk about that in just one second, are going to be restrictive. The monetary policy is certainly, the Fed isn't going to expand QE or add any. A Fed is going to remove liquidity. The only question is by just how much. That in and of itself acts as a kind of, suction of oxygen out of the air for risk investors. Because remember, the primary thing that NASDAQ loves is free money. When interest rates are zero, stock PE ratios go to infinity. When you reverse that dynamic, doesn't even matter by 25 basis points. Every 25 basis point move from zero is a massive re-rating to the downside. PE ratios compress. So growth is not the issue. Most of these assets are going to grow. It doesn't matter. They could grow 20% per year and all of this can collapse because it's not about growth. It's about PE expansion, which is why sort of, looking at it purely from a fundamental point of view is futile. You really have to look at this now from a macro point of view. The only question is the Fed going to, totally strangle the system or kind of ease and gently, remove some of the oxygen out of it? We'll have to see. My bet going into next week, and let's talk about next week as the calendar on the event. Really, next week, everything happens on Wednesday. It's really the only important day, right? We have FOMC, we have Australian employment, we have Kiwi GDP, and then Thursday we do have the MPC official vote, which is a sort of a secondary issue. But really, everything is going to just focus itself on FOMC and the big question as to whether the Fed is going to hike 50 basis points or 25. I would be shocked. Of course, everybody can be wrong, but I would be shocked if the Fed hikes 50 amidst this incredibly tense environment. Generally, Chairman Powell, really not known to be kind of a gunslinger. He is a careful, consolidative, ruminative type of a man who will choose the golden middle most of the time. And if you make that assumption, then it's quite likely that it'll just be a 25 basis point rate hike, which actually should be moderately positive risk, moderately positive equities. This again assumes, here's the perfect bullish scenario. We have negotiated ceasefire, or at best negotiated kind of a truce arrangement in Ukraine, followed by just a 25 basis point rate hike. That is a recipe for some really strong risk-on flows into next week. The absolute disaster scenario is we have a war of attrition that escalates both in terms of body count and perhaps even use of lethal force, followed by essentially a Fed that ignores all of that and says inflation is the only thing we care about. We're going to go 50 basis points to try to truncate that. That is just a death knell to risk assets, and I think that's really kind of the pivot point next week of how you want to look at the markets. So turning to FX, I mean, clearly the market, when you're looking at yen today, it's up a handle. It's up a figure, or more than a figure, one big figure, and that's a positive impulse that the market may be pricing in the potential for a 50 basis point rate hike. It's certainly acting like it's a very, very pro-dollar trade. And under those circumstances, so you have, again, as I said, in many ways, the worst kind of situation for the risk trades is Fed hiking 50, war getting worse. War gets worse, people are going to run to the dollar anyways. So you will have, it's not inconceivable that under that circumstances, we could see dollar yen go towards 120, which is, astounding when you think about it. Certainly from just a pure technical point of view, it's just, you have to do nothing but just be long dollars. We're making higher highs. The market has not topped out. We haven't broken any of our highs. And in fact, really, the only kind of technical move that could completely damage this essentially, uptrend, and if you do kind of a regression line, just a basic statistical regression line is just a straight up 45-degree angle. The only thing that could damage this completely is if we break down really below the 1450. We take out the month lows. That would be, highly highly unusual, but again, quite possible if we sort of get peace and the Fed doesn't really hike hard, then you could have just a massive liquidation because everybody seems to be positioned for a strong dollar trade. That's what the market is telling you. So you're buying at the highs, you're reaching out. So to me, this kind of a trade, you have to walk into this trade either with a tight stop and be prepared to be knocked out by volatility, or with a massive stop of like 2.5 to maybe even 3 full figures if you want to maintain your pro dollar stance. Anything in between that really isn't going to do you any good. You either believe that this is a longer term continuation and be prepared for just massive retraces, or you just trade the fast continuation and just nick yourself out on tight stops. Now, the flip side of that, of course, is Euro, which had a kind of a pro-risk move off the 108 bottom, came back up, found a pretty hard cement ceiling at the 110 level, and I still think just sort of on a fundamental level, Euro is in for some tough times because the ECB isn't going to really raise rates hard anytime soon, and still, the single clearest trade in the Forex market right now is basically short euros against the commodity dollars. We've had a big short covering rally over here that flamed itself out. Euro Aussie now is back underneath the mid month lows. Euro Kiwi, same kind of a trade. Euro CAD, same kind of a trade. It's basically the exact same trade that you want to trade. To me, we have Australia, so if you think Australia kind of comes in strong as the demand for commodities just kind of drives that economy harder, that's a trade that's a pretty clean trade. Now again, here you do need to give yourself probably 52 as a stop in order to give yourself all the breathing room for churn. But overall, this is fundamentally the cleanest trade, and we've hit our retrace point. We had a reversal. This is a pretty good signal for possibly move back down to the 145 level. Euro odd would be my trade of the week as we enter into this week. Wish you guys the best of luck, the best of trading. Let's all hope for peace, as John Lennon did, and let's hope that we have better news next week. I wish you guys all the best. Boris Schlossberg, over and out.